I'm Sarah Smith. I'm the Chief Operating Officer here at the American Action Forum. Normally, our fearless leader, Douglas Holtzaken, would be introing, but he's been called away on a relatively last-minute engagement. So you're stuck with me. Topic for today is what's next for Fannie Mae and Freddie Mac, and whether optimism about the prospects of housing finance reform are merited. We probably have no better person. There's probably no better person that we could have here other than Dr. Mark Calabria. Many of you are probably very familiar with his background and his expertise in this area. He was confirmed a mere 7 months ago, and he's really hit the ground running. I think it would be hard for anybody to say he hasn't. And so we're thrilled to have him here to give us a little bit of insight on what's ahead and what can really be expected. Before he was at FHFA, he was the chief economist for Vice President Pence. He was a longtime director of financial regulatory studies at the Cato Institute. He was senior aide at the Senate Banking Committee under two different chairmen. He was active in the 2012 Flood Insurance Reform Bill, the Housing and Economic Recovery Act in 2008. And of course, he was also Deputy Assistant Secretary of Regulatory Affairs at HUD before that. We are so pleased and flattered that he's provided some time for us today, and I hope you'll join me in welcoming him.
Well, thank you, Sarah, for that very kind introduction. Despite Doug kind of sneaking out and leaving me here without him, I'm still going to say the nice things about him that I was planning to, because going back before the crisis, you kind of sometimes hear, well, who would have ever guessed that Fannie and Freddie would have gotten themselves and cost the taxpayer lots of money? Well, in fact, then CBO Director Doug Holtzaken guessed it and said it and was before the committee a number of times when I was on the staff of the banking committee. So I think Doug deserves a tremendous amount of credit for being right back before the crisis, and I certainly haven't forgot that and appreciate. It's hard not to forget because the number of people who were right you can count on one hand. So I'm pleased to see that Doug was among that. Let me also say how flattered I am to be followed by such a distinguished panel of experts, and we'll be sorry if I miss part of that conversation, but I know it will be very lively. If I can pivot off of where Sarah started on the point about reason for optimism, I'm optimistic. I wouldn't have taken the job if I wasn't. I'm not one to generally set myself up for failure, but we'll find out. Let me say that I'm partly optimistic because I think you've got administration plans from both HUD and Treasury that really do lay out, in my opinion, a responsible plan that helps build a more resilient housing finance system. And if I can say that's really the bottom line goal of what I'm trying to achieve administratively, and I think that what the administration is trying to achieve, which is to simply have a more stable system. And so that we can avoid these kind of bailouts and we can have lasting reform and kind of get this done for a generation. Let me to give you some sense of what we're against, however. It has been 11 years since the crisis. Housing finance reform is probably the biggest part of that was not addressed. I worry that over time we had developed a sort of sense of complacency with the conservatorship. But I think if we're going to move to reform, or we're going to have that optimism reform both on the administrative side and the regulatory side, that we need to be able to build that momentum and be able to push for reform and an emphasis. And hopefully this time around we can get it done before the crisis rather than wait after the crisis. If I can channel a little bit, I hope this has allowed an American Action Forum for me to maybe channel President Kennedy for just a second and say the time to repair the roof is when the sun is shining. And to me, I really do emphasize, I think we've got a really good housing market. I think we've got a really good economy. I actually think that's a stronger reason to do reform now rather than delay. Let me also say, I think some of you know that my training is an economist. I think since we've got a couple of economists in the room, you appreciate that when I say that as an economist, I really love meteorologists because they make economists look like good forecasters. You can laugh at that point. And this is to say with the modesty of, I don't know where we are in this cycle. If I can channel the nationals, perhaps, I think we're more in the 8th or 9th inning of this housing cycle than we are in the 2nd or 3rd. I will be delighted if this housing cycle goes into extra innings. That would be great. But again, I think my philosophy as a regulator, and I think this should be the philosophy of every regulator, is you really have to, while you hope for the best, plan for the worst. And again, I don't think we've repealed the business cycle. I don't think we've repealed the housing cycle. And my objective is to try to make sure the institutions I regulate, not just Fannie and Freddie, but of course the Federal Home Loan Banks, are in a condition where they can be a source of strength in a crisis. And so again, trying to get ahead of that. I'll remind you the last crisis really was, if we think about any institution's balance sheet, we had not enough capital on one side of the balance sheet, and we had not quite the best asset quality on the other side of the balance sheet. And really that lack of capital to back poor asset quality in the mortgage lending space, to me, was maybe in a very overgeneralized, simplistic way, what got us in the trouble that we were in the last crisis. So I'll remind you of some of where we are today. I think, as you're aware, Fannie and Freddie guarantee $5.6 trillion in single and multifamily mortgages. That's about half the market. I will note that the day I walked in the door, almost 7 months ago, they had between them $6 billion in capital. So for those of you who aren't really quick in math, I'll make this easy for you. When I walked in the door, Fannie and Freddie were leveraged approximately 1,000 to 1. To be clear, no financial institution survives that kind of leverage in a stressed environment. I am delighted to say that because of the agreement that I've reached with Secretary Mnuchin to suspend the letter agreement, to suspend the capital retention under the purchase agreement that allows Fannie and Freddie to raise $45 billion total over time, that today, in the almost 7 months I've been there, we've essentially tripled capital. I'm not sure that I can keep up that pace. We'll try. Certainly, I'm not sure that any other regulator has probably raised capital at that kind of rate, but I'm really proud to say that we have made significant gains and will continue to make significant gains on increasing the capital of these enterprises and lowering the risk on the balance sheet. Let me turn, however, that's the capital side of the balance sheet, which obviously I'm of the belief that capital is probably the most foundational element of financial regulation and safety and soundness. And if you don't get that right, the rest of it's just not going to work. So getting that to where the place we need to be. I'll come back and talk about the capital a little bit later in my remarks. But again, just reminding you, these institutions are still leveraged over 300 to 1. So it's not 1,000 to 1, but 300 to 1 is not a good place to be either. Let me go to the other side of the balance sheet, however, and talk about asset quality of the mortgage side. I'm of the view that while there have been some modest increases, we certainly see average borrower credit to be slightly higher than it was pre-crisis. If you look at Fannie and Freddie's book, however, average loan to value, which of course is sort of the flip side of debt payment, average loan to value is higher than it was pre-crisis. For instance, typical borrower in Fannie and Freddie's book is more highly leveraged on their house than they were pre-crisis. That's also the same for debt to income. And while we've made some modest progress in the last 6 months in reducing some of that, I think it is important to keep in mind that the book of business that Fannie and Freddie, that I've inherited, is not all that dissimilar in risk from what they had pre-crisis. And of course, they had a whole lot more capital pre-crisis than they do today. So a tremendous amount of risk. Now, I will say, I occasionally will hear the point, but delinquency rates are low. Of course, I will remind you, delinquency rates were actually quite low well into 2008 as well. And so again, there's an old adage among lenders that the worst loans are made in the best of times. And the fact today, if you look at delinquency rates in Fannie and Freddie today, they're very similar to where they were 2007, 2008. So again, the early part of the cycle reflects some of the same risks that we're seeing today. I don't mean to be dismissive about some of the progress that's been made in sort of loan quality. We certainly don't see the kind of ninja-type loans with no documentation and such. Certainly those factors have gone away in Fannie and Freddie's book. But I'll also remind you that fundamentally the most three important things driving default are borrower credit, LTV, DTI. Everything else is a distant second in terms of qualifications. And by and large, those factors have not improved considerably to where we were pre-crisis, at least not to where they are today. Let me also say that part of the reason that I believe we need to move forward, let me emphasize first that the choice to exit conservatorship, which I'm going to get into a little bit more detail, is not necessarily a choice. It's a statutory mandate upon me. I believe I'm obligated under statute to fix them, get them out. I also think it's important because previously in conservatorship, you actually saw the credit quality within conservatorship decline in the last few years before I came on board. And I think ultimately helping get Fannie and Freddie out of conservatorship will decrease the degree to which they are subject to politics. And if we want to depoliticize mortgage finance, I believe exiting conservatorship and getting these companies to look a lot more like other normal financial companies, which we can debate how depoliticized those are. That's a separate conversation. But I think getting them out as private as we can, will be important to kind of reducing some of the politics around them. Now, I do again think that the Treasury and HUD reports kind of lay out a good direction for this that I can work with. Again, I'll emphasize independent regulator. Those are the administration's reports. I do support the aims. And many of those aims were reflected in the scorecard and strategic plan that was released just a little bit more, about a week and a half ago. And I want to talk a little bit about that, what we released. Let me say that these two documents, the scorecard and strategic plan, really do set the broader parameters for Fannie and Freddie in terms of what they engage in, where they devote their resources, where they devote their attention. There are three main focus points, if you will, of the strategic scorecard. And the first of all is having Fannie and Freddie help foster a, quote, competitive, liquid, efficient, and resilient national housing finance market, and really kind of bring in competition. Let me emphasize, as many of you know, I was involved in helping create HERA, which created the agency that I run today. Congress was very intent, for instance, on combining the previous regulators, OFEO and the Finance Board, because Congress wanted a regulator that had a broad perspective on the housing market, not simply a regulator that was obsessed with one or two institutions. And if you look in the statute, actually under the first list of duties that I'm supposed to carry out, one of those is helping create a competitive marketplace. And part of the direction that I've given Fannie and Freddie is working with me and working with my other regulators and colleagues to how do we fix the regulatory landscape to create a level playing field so that we can get more competition in the mortgage place. So that's number one. Bringing the scorecard, number one point is bringing a more competitive marketplace to it. Number two is, of course, reminding Fannie and Freddie that they are in conservatorship and how they should operate in a safe and sound condition. One of my worries coming in about, again, almost 7 months ago, was I had felt that there had developed a general complacency around the conservatorship, somewhat an expectation in Washington that the conservatorship might just go on forever. And certainly a drift, if you will, at the GSEs where these were no longer companies operating as if they were in conservatorship, but kind of getting back to business on a daily basis in ways that I thought were inappropriate for entities in a conservatorship. I will, of course, remind you, those of you who aren't lawyers in the room, the one or two of you who might not be lawyers, a conservatorship is essentially administrative bankruptcy. So again, I think because this had gone on for 11 years, we kind of had forgotten that Fannie and Freddie were bankrupt companies. And to me, if you're a bankrupt company, you're in a bankruptcy, that dictates a sort of set of actions that you might not take if you were a normal company outside of bankruptcy. And so part of this scorecard is reminding them you're in conservatorship, act like it. And the last, of course, is to prepare for an eventual exit from conservatorship. You know, many of these changes I think we've been signaling for the 6 months that have been there. Some of this, I'll mention a few to give you some details of how these items have been carried out. So, for instance, many of you may be aware of the new multifamily loan purchase caps we released for Fannie and Freddie. You know, these really kind of keep them where they were as a footprint. They're not growing as a market share, but nor are they shrinking. I also think it's important that they not crowd out public capital. I think it's important in the multifamily space, particularly. There are a variety of sources of multifamily capital, not just banks and insurance companies. So I think it's important that Fannie and Freddie not dominate that market any more than they already do. But again, this is done in such a way that there's not going to be disruption to that marketplace, but really helps bring in private capital, which is such a crucial element, in my opinion, of having a competitive mortgage market. I'll just note for detail-wise, that cap allows for a $200 billion combined cap through the end of 2020. I think this will allow, again, Fannie and Freddie to continue to do business in a way that really kind of keeps them focused. I'll also note for those of you who don't follow the topic, there were exclusions previously to the cap. The exclusions were becoming bigger than the caps. So again, to me, I thought it was important if the caps were actually to have some integrity, that they were actually real caps. So there are no more exclusions to the caps. All of that was rolled in under the caps. We also reduced some of the things. There were a number of things that were being done in exclusions under the so-called green. Many of these things, low flow showers and things like that we can question how green that is. But we certainly were seeing much of the conventional market go that direction anyhow. So my worry partly was that the practices in the conventional market would have eventually led to almost everything being excluded. Again, undermining the very notion of a cap, but also trying to make sure that we were bringing competition to the marketplace in that same way. Let me also mention we have done a number of other things that have tried to bring a level playing field among originators. I'm very much of the view, I think the facts very clearly support that pre-crisis Fannie and Freddie engaged in a number of activities that drove consolidation among originators. You would not have an unusual pre-crisis where Countrywide would come in and pay rates here, get different terms than the community bank would come and pay here. And Fannie and Freddie were very much competing on buying volume before the crisis. And so what we've tried to do is make sure that pricing is the same, but I also want to emphasize it's not just about pricing. Because I believe today, to the best of my knowledge, they're not engaging in price discrimination across lender size, but it's also terms and conditions. So I would unfortunately come in and be told, well, these are the terms under which we offer this product. And then I would find out later that here, lender A and lender B were actually getting a different set of terms. So we've tried to the best as we can push Fannie and Freddie away from having exceptions and variances for lenders so that they're not necessarily competing for market share, but that they're, let me say it all, they shouldn't be competing at all in conservatorship. And that's a message they've gotten from me, is that while you're in conservatorship, you're not to compete with each other over market share. You're not to reward executives on compensation based on market share. Once you're out, go ahead, be tough competitors. But while you're in conservatorship, the focus should be getting out of conservatorship. Another issue that we've been working with our fellow regulators on, I think many of you are aware of CFPB's effort to fix the qualified mortgage rule. We've been working with CFPB. We will provide them data. Fannie and Freddie will provide them data. It's really critical to me that we allow the patch that allows Fannie and Freddie to be exempt from the QM to expire and to be able to get a marketplace where everybody is under the same set of rules. I'll simply say as an aside, there's no statutory basis for the QM patch. This was meant to be temporary all along. I believe Congress actually debated giving Fannie and Freddie exemptions from the QM and rejected that. So again, I think the initial CFPB decision years ago to exempt them was not based in statute. But more importantly, I think it's important that everybody have the same set of rules in the marketplace and we have a QM that works for everybody. We will be working with CFPB. It's ultimately their decision what that looks like, but we will continue to urge that Fannie and Freddie provide data, that we provide data, that we can give whatever resources the CFPB that they need so the patch expires on time. And that we have a stable marketplace after that. And again, I think that that's one of the ways that we can do that and help them operate in a safe and sound manner. Also mentioned the SEC put out a call for information earlier this week on Reg AB, which those of you Dodd-Frank land might better know is the QRM, the Qualified Residential Mortgage Rule. Reg AB, in my opinion, has been a real obstacle to the growth of a private label mortgage-backed securities market. So, of course, while it is up to the SEC to fix that, we have regularly encouraged the SEC to deal with AB and have offered to provide whatever assistance we can in the marketplace. To maybe give you some contrast, I believe on the typical Fannie and Freddie credit risk transfer deal, something like 70 data elements are provided, whereas Reg AB requires 270. So I'll set aside that, as far as I can tell, having looked at a large number of studies on mortgage default, about a dozen or so data elements really explain most of the default. And so, again, trying to encourage the SEC to get some alignment with what's being done in the rest of the market so that we can bring back private label securitization is a really big, important part of this. And as you can tell, somewhat I spend a lot of my days talking to my other financial regulators and impressing upon them that while I have the most to fix within the mortgage finance system, they all have a role to play. And if we can coordinate regulators and get relief in other areas, we can have a more level playing field. And that's something that we will continue to work on. I mentioned earlier the risk profiles. I take as a very basic fundamental principle of good risk management as well as financial regulation that the risk you take on the asset side of your balance sheet has to be related to the capital you have to support that risk. I think it's fair to say that at over a 300-to-1 leverage, that the risk that Fannie and Freddie are taking today are in excess of the capital they have to support that risk. And so while on one side of the balance sheet we'll continue to raise capital, on the other side of the balance sheet we will continue to better align the risk that is being taken with the capital that is there to support it. So if it's not clear from those remarks, my objective is to make sure that whatever losses are incurred on the asset side of the balance sheet are covered by the capital that these entities have raised themselves. I won't even begin to have a conversation about thinking about having the taxpayer cover that. The intention is that these entities are self-supporting. And again, having worked on that to make sure that we can build that capital as well as realign their risk profile, I think will get us in a point where Fannie and Freddie are able to exit conservatorship and do so in a responsible manner. But I also want to emphasize, and you've already seen this in some of the dealing with some of the risk layering, we still see a very small sliver of loans that are high LTV, high DTI, low FICO, and those really are the riskiest part of the profile. The loans, one aspect of this that was mentioned by Dr. Carson in the HUD report is the overlap between FHA and FHFA. I'll say as an aside, as somebody who's been involved early on legislatively in these programs, if I knew I was going to spend so much time talking about FHA, I might have named the agency I'm running something different than FHFA, but you can indulge me not to mix up my acronyms a little too much. A really big part of what we're working on in the scorecard and what we're working on HUD is aligning these programs. I really want to emphasize the objective is to have no gaps. There's not an intention to have any loan orphaned, if you will. But the objective is also to make sure that Fannie and Freddie don't essentially skim the cream off the top of FHA. To me, there's a real risk that if Fannie and Freddie pull off the better risk within FHA, you will end up worsening credit quality of FHA, which will force FHA to actually raise premiums. So I do worry about sort of an adverse selection spiral downward at FHA. So part of our objective is to make sure that FHA is not being undermined by the activities of Fannie and Freddie. And I'm certainly of the belief that pre-crisis, that a very vigorous competition between the GSEs and FHA really undermined FHA, but also resulted in a worsening of the credit quality on Fannie and Freddie's book. So as maybe difficult as it is sound, I think it's very possible to move a sliver of business from Fannie and Freddie to FHA that at the same time raises the credit quality at both Fannie, Freddie, and FHA. And I think we can do that in a sustainable manner. And again, we've started initial conversations with Dr. Carson and his team. Our hope is eventually to have some sort of memorandum of understanding, but I would really mention we're at the beginning of that process. Also mentioned the letter agreement earlier that allowed us to start to raise capital at Fannie and Freddie. This gives us about a year and a quarter to really work out a next set of changes to the underlying PSPAs where Secretary Mnuchin and I can start to chart a path out. A number of things that have been done within conservatorship ultimately need to transfer out. So while these are confidential, I can mention the number-wise, which is we've issued just over 300 directives in the life of the conservatorship for Fannie and Freddie. Some of these are very modest, everyday things. Many of those are going to fall away. But it became a practice at FHA that many things in which you might do through supervision and regulation were done via directive and conservatorship. And again, that might be appropriate in the long run. But part of what we're doing is asking ourselves, which of these need to be hardwired into regulation? And so some point next year, you will see a sort of catch-all hodgepodge regulation that tries to hardwire a number of these directives so that they stay in place as we exit conservatorship. Of course, many of these we'll find out whether we have statutory authority to do via reg. Some of these in which we might not be able to do via reg will enter the PSPAs or at least that conversation. So I will emphasize that Secretary Mnuchin and I are still at very early stages. We have not finished our internal process at FHFA deciding which of these directives need to be hardwired into PSPAs, which will be hardwired into regulation, because as I said, there are over 300 of them, and you can imagine going through all of these has taken a significant amount of time. But it's important that we make sure that as there is an eventual exit out of conservatorship, that we've strengthened the supervisory regulatory powers and we move those responsibilities from the conservator to the regulator and make sure that the regulator itself is ready. So I would really emphasize that while a lot of the attention will be getting Fannie Freddie ready for an exit out of conservatorship, it's also important that I get FHFA ready for an exit from conservatorship. I will remind you that for maybe all but 2 months of the life of this agency, Fannie and Freddie have been in conservatorship. That means a different relationship that you would have than if you were a regulator. So again, making sure that we have the resources and the authorities in place in the regulatory system so that when they do exit, they are appropriately regulated in the way that they need to be. I'm very optimistic that I think the time that we have, which again, this is a considerable amount of time that we've built up, that we'll be able to get FHFA where FHFA needs to be the regulator that I know that it can be. I mentioned earlier one of the prerequisites, in my view, for an exit of conservatorship is finishing the capital rule. I don't have an update for you today, but simply to say I can see Isaac is a little disappointed. Sorry. The emphasis of I will be able to hopefully announce next couple of weeks whether we'll be reproposing or not. Again, because it was a lack of capital that really got Fannie and Freddie into this situation, I view the capital rule as probably the most important rulemaking I will be undergoing. So it's got to be done right. And I know this might be unusual for a regulator in Washington, despite the fact that it's a 100-plus page rule. I'm actually reading all of it, trying to understand all of it, trying to make sure we get it right. So you can imagine that actually takes time. And so, again, we'll be announcing soon whether we be reproposing or not, because, again, I think it's so critical to get that right. But I also recognize that it's also critical to have that done before there's any opportunity that Fannie and Freddie may go to the public markets and raise capital. And, again, I will emphasize that it will be Fannie and Freddie raising capital. We will be creating mile markers that they will have to meet. And, again, trying to get capital rule in place is one that I will have to meet. But again, I'm optimistic that we can get there. I do want to wrap up by emphasizing a couple of broader points, one of which is the exit from conservatorship. All of this is process-driven. It's not calendar-driven. If the day I walk out the door on April 10th, 2024, which unfortunately will probably be a late night for me, if they're not ready to go, they don't go. But my hope is that they will be ready to go long before then, that we get the things in place we need to make sure that happen, get them ready for the next crisis. And again, fundamentally, the objective here is to get Fannie Freddie in a situation where they don't fail during the next downturn. I think that's a reasonable, modest objective for any financial regulator. It's one, unfortunately, that they don't meet today, but I think over the course of time, the next couple of years, we can get them to that point. So let me turn it back to Sarah. Sure, absolutely.
Great. Grab this mic so I don't have it handy. Quick reminder, if you would identify yourself and your affiliation and ask your question in the form of an actual question. That would be great. That'd be great. So I'm going back here.
Hey, Mark. Chris Smith, how you doing?
Good.
How can you think about letting entities go out and raise capital in the public markets when they're still backed by the full faith and credit of the taxpayer?
They're not backed by the full. There's no explicit guarantee on these entities, and no one should ever come to believe that there's an explicit guarantee. But I don't have an option but to fix them. The statute commands me to either rehabilitate them, fix them, get them out, or take them in receivership. Endless limbo is not an option in the statute, and if I do nothing else, it's follow the law. So thank you for the question, Chris.
Great. Any others? Here we go.
Hi, Isaac from Compass Point. Would you talk a bit about the Treasury's recommendation regarding rent control and how you think about that, and if that's something that's anywhere on your already very long to-do list?
I thought as an economist we'd settled that debate years ago, but here we are. Let me say as an aside, if you've never read, maybe the last time you hear me say this, wonderful op-ed from Paul Krugman back in, I think, 99, 2000 on rent control. If you really want what the economic profession says on it, you should say that. Let me, more pivoting back to me, maybe when I fix everything in Washington, I might go to Albany or Sacramento and try to fix things there, but I've got a lot to do here. I don't foresee my responsibility as fixing everything at the local level. I do see, however, whether it's rent control, whether it's any sort of state and local policies, anything that affects, for instance, the discounted cash flow to a property that affects property value affects underwriting. Now, of course, there may be circumstances where rent control reduces supply, increases property values. This is an empirical question. We're not approaching this from a policy viewpoint one way or the other. Again, it's not my job to try to fix policies at the state level. It is my job, however, to make sure that the properties that are underwritten by Fannie and Freddie are done in a responsible manner that reflects the actual risk of those properties. So whatever we end up doing on rent control will be driven by the data, not driven by pre-existing policy preferences.
Do we have time for one more?
Sure.
Okay, great. Would you pass that mic down?
My name is Xiao Wang, HSBC. Absent any congressional action, especially around implementing an explicit guarantee, right, is something the market is hoping for. Would you see the release of the GSEs from conservatorship as a negative impact to the market, if the housing market, if there's no explicit guarantee, and if they're still viewed as
I would emphasize
private.
that whatever guarantee market participants believe they have will be the same in conservatorship or out of conservatorship. So that I'll leave market participants to figure that out. I will simply emphasize we've called Congress. The administration has called for Congress to create a guarantee. That's on Congress's decision to make. I do think any guarantee should be very clearly defined, should be paid for, should be limited. I don't have the authority to create a guarantee. I'll put it this way as I wrap up. I'm at heart an Article 1 guy. I'm not legislating on behalf of the legislators. That's their job to do, not mine. I'm going to fix what I've going to be fixed, and I will carry out what I've been directed to carry out. And again, I will emphasize, exiting conservatorship is not an option. Let me wrap up by saying I don't know how over time to develop this myth that you're supposed to wait for Congress. That's not in the statute, and it is a myth. I've never known the FDIC to call Congress and ask for a bank to be released from conservatorship. That's simply not the case. So I'll end up by saying I'm not going to wait on Congress to tell me to do what Congress has told me already to do, which is to get them fixed, get them out, and if they're not fixable, we'll be taking them into receivership. I will very much emphasize the conditions around receivership are not here today. Were they to present themselves, it's in statute. We would not ignore the statute. We would follow the law as required. So, again, I would say for market participants, I guess I would lastly say, were I a creditor in Fannie and Freddie, I would like to see under any circumstances a whole lot of equity in front of me. And that's what we're going to be trying to achieve, is a whole lot of equity in front of creditors. And I think that should give market participants, that's the most effective way that I can give market participants comfort short of congressional action. So thanks, Sarah. Thanks, everybody.
Thank you. Please join me in thanking the director. We'll do a quick set change here just to make sure that we have enough room for our esteemed panelists. In the meantime, let me introduce our moderator, who's Donna Borak. Donna is currently a senior economic writer at CNN. She's got a focus on regulatory and economic policy. Her topics range from recent federal regulatory changes to economic sanctions in North Korea and everywhere in between. She's also written in the past for the Wall Street Journal, American Banker, the AP, and UPI. So without further ado, let me welcome Donna to the stage along with the rest of our panel, and she will happily introduce our other panelists.
All set. Thank you, Sarah, for that kind introduction, and to everyone here this afternoon for joining us for what I anticipate will be a very lively conversation about what's next for Fannie and Freddie. It's a tough act to follow, Dr. Calabria here, but I'm sure we will do our best. It is my pleasure to introduce our esteemed panelists today. To my right, Dr. Norbert Michel, Director for the Center for Data Analysis at the Heritage Foundation. Next to him is Dr. Michael Stegman, Senior Fellow for the Housing Finance Program at the Milken Institute, Center for Financial Markets. And finally, Thomas Wade, Director for Financial Services Policy at the American Action Forum. Thank you all for being here this afternoon. To our audience, we'll start this conversation here on the stage, and we will certainly leave room for all of your questions, and I understand Sarah will be helping us facilitate that conversation. I wanted to sort of set the stage, but I feel like Dr. Calabria did a pretty good job of doing that himself, so I don't know if there's anything more that I can add to this. But I'm curious what your initial thoughts are. Anything that surprised you? I know that everyone here in the room was sort of waiting to find out whether or not we would find out some news on the capital plan. Initial impressions?
Well, I'm not surprised that we didn't.
You're right.
I think that's the key part of all of this, really, and that's known, so that's good. That's whatever they do with that capital rule is going to determine how quickly things unfold and how quickly they do or don't get out of conservatorship. And I think it's important to note that he has repeatedly said some version of what he just said, which is receivership's on the table too. It's not, I'm going to let him go. There's a very clearly defined set of rules in the statute, and we're going to follow it. And if they don't meet the requirements, one of those options is receivership. Right. And if we have a downturn now, under the condition that they are, in the condition that they are now, they would not make it out. So, I mean, I think that that's something that market participants should pay very close attention to, because I know that Mark is going to follow the law, and I think everybody should feel very confident in that.
Yeah. Michael?
Again, the capital rule is absolutely pivotal and critical. Milken has been on the record for wanting to see it reproposed. I'm hopeful at least that it will be either an interim rule for effect, which allows additional public comment, or partially made final with requests for comment. But a number of comments that the director has made suggest the possibility of quite significant and substantial changes in that proposed rule. One of the kind of political constraints that faces the director is the prospect of a change in the composition of the Senate in the election, and the possibility, if you repropose that full rule, it could be within the window of the Congressional Review Act, the 180 legislative days following, right, it's put into effect, where it could be rolled back. And so I don't think you're going to see a full reproposal because of that risk, and it'll probably bounce, but we've got to know more about it. It's absolutely the critical decision.
Yeah. Tom, did you want to weigh in?
Only that the director did a great job of setting out a lot of the different competing demands on him in his role, from obviously removing the GSEs from conservatorship as soon as possible, to de-risking them, to reducing their footprint and building up their capital, which are all obviously very different demands on him. One thing I found particularly interesting is this idea of making the GSEs resemble private competitors in the market insofar as possible. And I think that's going to be such a key challenge for the FHFA moving forward, because of course, even if we remove the GSEs from conservatorship, the charter would remain, and Congress is required to amend the charter. The GSEs outside of conservatorship, but with the charter unamended, would retain a host of hugely systemic advantages, like tax-free status, or not needing to get SEC registration, or the Fed being able to buy the GSEs MBSs. So for me, the real challenge there is outside of congressional activity, and we can discuss that further. How far would the GSEs out of conservatorship allow for any form of competition in the market?
Just one thing more about leverage and capital. Since I was kind of part of the last crew, if you have a leverage ratio of 1,000 to 1, you have no more than $3 billion of capital. How do you continue to issue MBS and have investors take the full confidence that you have enough capital to pay off the guarantees in the event of foreclosure and high levels of default? And that's because there's $250 billion of taxpayer capital that is really married to the MBS. And so to say that they did not have any capital, and that is what really puts them at risk. The taxpayers have already invested that in the future support of the GSEs. That is the guarantee that would go forward if they exit conservatorship, unless they go through receivership, and that guarantee stays with the legacy book. So we have a long way to go, but it's not as if the global investment community was just hoping for the best when they continued to invest in the GSEs when they entered conservatorship.
Right. There's a lot to unpack in all of the statements that you just said, but I'm kind of curious myself, because I've been in this town for a very long time and was covering the financial crisis and the regulatory reform efforts post-crisis. we've talked about GSE reform on multiple occasions. Even, Michael, in your own administration, there was an attempt at GSE reform. We've seen multiple bills on the Hill to sort of address this issue. What makes this time different? Does it feel different? Is there a sense that we can actually, that Dr. Calabria can actually get this across the finish line before his term expires, if not sooner?
I mean, my view is he is on a clear path to administratively exiting conservatorship on what he says is a not a calendar-driven process. I do think that the election is going to potentially hasten the pace of change. The administration has asked the Supreme Court to weigh in on two pretty important issues dealing with the net worth sweep and the whole question of what do you do about the senior preferred stock that has to be addressed, and taken a position different from the directors about whether his position is constitutionally valid or not. And so all of that is going to happen in the spring, and along with what we saw last night, there are some pretty nervous people about picking up the pace of exiting conservatorship if that's where you want to go. There is no chance for legislation, certainly between now and then. So I'm concerned that that benchmark-driven process may speed up, and that's not good.
Michael, in terms of the atmosphere of the politics coming into 2020 that Michael's talking about, and how does that cloud sort of what the administration is able to do, and even more broadly to all of you, is if Congress seems like it's in a position where it is unable or does not have the appetite to do anything legislatively, how much can the administration actually get done here? What are the limitations or the scope of that?
Well, I mean, they can do a lot. I mean, it does become political just in the general sense. I mean, we're in Washington, so you'll have that issue. But I mean, in terms of the process, you know, of getting out of conservatorship, I mean, that's set, and that process is set. The timeline's not. And in terms of other reforms that Mark and FHFA could make, I mean, they can do that now. They can raise the G fees. They can shrink conforming loan limits. Excuse me. They could clamp down on cash out refis that they back. They could clamp down on non-owner occupied backing. I mean, there's a lot of things that they could do. As far as that goes, it's just a question of how much do they want to do and how quickly do they want to do it.
By the way, the more you talk about getting rid of product lines, reducing conforming loan limits, shrinking volume, that affects really the business side, the profitability, the desirability of investing new equity in what these entities are going to be. All of these things are connected, and it also really dramatically affects the generation of cross-subsidies that have been the foundation of the affordable lending of the GSEs. And so very intricate and delicate kind of networks. All of these elements are interconnected.
Another one popped in too. I mean, in terms of what he can do and can't do. I mean, in practical terms, he can do all these things. But
Right.
the PSPA is you have this liquidation preference that says, okay, before we can do anything else, you got to pay back $200 billion. Well, if you reduce that amount, that's another bailout of a sort. Effectively, that's another bailout. It's not sort of, it is. So, are you going to do that? I mean, that's, and anytime you make any of these changes, as Mike was alluding to, you've got the realtors, you've got the builders, you've got the bankers. Nobody wants to touch anything. If you talk about reducing LTV, if you talk about taking the minimum down payment from 3.5% to 5%, you would think the world was going to end. So, you know, the staff at FHFA has to, you know, either be strong enough to push back against that and say, no, this is what we're doing, or this is just going to keep getting drawn out longer and longer.
Right.
But just sorry to pick up on one thing there.
Yeah.
Even if we could hypothetically end up in some situation by the end of next year or the year after, where we could exit the GSEs from conservatorship and somehow deal with the preferred stock, whatever that looks like. My fear here is that we are working towards having the GSEs exit conservatorship without addressing the underlying reasons that put them there in the first place. I think we would all agree that having the GSEs exit conservatorship is a good goal, but at most, the administration can put them back to the position they were pre-crisis, and how desirable is that?
Right.
So, one of the questions that, in thinking about today's session, that I had not thought about before, and it has to do with whether the likelihood of congressional action to make guarantees explicit, to put into law capital and whatever the other kind of requirements that we're talking about, fixing the charters and so on, how likely is that to happen after conservatorship ends, as opposed to trying to deal with comprehensive housing finance reform where the options are nationalize the GSEs, eliminate the GSEs. Once they exit conservatorship, the question is, that they are going concerns, you haven't fixed critical issues, whether it's competition or the explicit nature of the guarantee, that making sure it's paid for, all those things. Does the prospect of legislation improve than it has been exit? I don't know the answer to that, but I think we have to begin to think about that question.
Yeah.
I could have jumped on
Sure,
there,
please.
and I don't think that it does. I think you're right, but I do not think it gets better. I've seen too much of this back and forth. I just don't have any faith in it at all. And what we'll end up with, and I think this is unfortunate, if they do get out of conservatorship under the law, under the process, what we will have are two giant companies by themselves with an obvious connection to the Treasury. I mean, let's get real. And they back about half the market, which is exactly what we had before. So what have we done? I mean, we've accomplished nothing.
Right.
It's very that's not my preferred outcome.
Right, of course. Well, it seems to me that there is still so much to be done before we can even get to that point. And so I'm curious what you all think in terms of what the challenges are. I mean, even just looking at being on the path to recapitalization, I mean, there are several issues that need to be addressed. We need to know finalizing the capital standards, setting the size of the commitment fee, resolving issues of the QM patch. Those seem like significant elements that we need to even get to before we can have a conversation of what is life like after the conservatorship.
Yeah.
Any thoughts around, because Dr. Calabria talks about this regularly in terms of channeling, talking about fixing the roof and the sense of urgency and the fact that we're now probably in the 8th or 9th. And given all that needs to be done, I mean, can you talk about the tension of how do you move this ball forward? How does the administration, how does he do that while being cognizant of not trying to get to a point where if there is a macroeconomic effect, we have a real problem on our hands?
Well, I mean, do you want to go ahead?
No, go ahead.
I might be in the minority here. I might be on the far right crazy flank, but my view is you're looking at, if you base it off of the proposed capital rule and the existing liquidation preference, you're looking at about $400 billion in capital. That dwarfs every giant IPO we've ever had in the world. There's no point in doing all of this, especially when you're going to end up with two Treasury-backed companies backing half the market, which is what went wrong in the first place. So, in my view, go ahead, don't repropose the rules. Go ahead, issue them. Say we've got them now. Give them a time where they have to raise as much capital as they can, and if they can't, that's it. There's receivership built into the statute, and that's the route we're going. And that's putting all your cards on the table, and that's it. Like, I mean, that's the clearest path forward to me.
Yeah.
I don't think they're going to do that, but that's what I would. That's the way that I would do it.
Yeah. Tom, do you have a thought?
Oh, I don't understand baseball, so I missed half of that. One aspect I find really interesting, and I'd be delighted to know everyone's opinion, is the interface between the new capital rule and any FSOC requirements, because it seems so staggeringly obvious to me that the GSEs released from conservatorship would be designated as SIFIs and regulated as such. And 400 is a scary figure. I have no idea what that figure would be if we applied, say, a 15% leverage ratio that might apply to a large bank. But I do wonder, and forgive me if this is cynical, are we spending too much time thinking about the FHFA's capital rule if FSOC's rules are just going to apply anyway?
Oh. That is an interesting. That is an interesting question.
That's a good question, but I don't know that they would. I think you would see sort of the same murky process. I think everybody wants to wait for somebody else to do something, and given that rule is already out there, my guess is that they would try to add on.
Exactly.
But that's just my guess.
I mean, the principle has been similar capital for similar risks that they've been really talking about. But getting back to your $400 billion and the senior preferred stock, I mean, really, that has to be addressed. But what you're really looking at in the senior preferred stock is whether you get rid of the net worth sweep or not, there's a 10% dividend rate. And just with the $200 billion of investment that Treasury has made before you add the $45 billion and so on, 10% dividend wipes out all income, all profits from. So forget the sweep. You can't live with a 10% dividend and raise equity capital. And so that's why you've got the financial advisors. That's why you have to have the capital plans that Fannie and Freddie have to develop, but you've got to address, right, how to, whether it's converting that senior preferred to common and holding that for years and years until after you raise, new capital. We're a long way off from that.
Yeah.
And so if it's going to be not calendar driven, it's going to be long after the elections and so on before you can see the exit.
Yeah. Well, since Dr. Calabria didn't give us a sense of exactly what the capital rules might look like, I mean, can you talk philosophically about what you think that might be the appropriate capital regime for these two entities? Like, how much would they need to raise in order before, to your point, Michael, to become attractive to potentially outside investors, and what that process might look like?
If you just forget the dividend for a second and the profits, what you're looking at is really what loss absorbing capacity does equity have to play given the risk profiles, of the GSEs. And my view has been that the proposed rule is not far off the mark. I know there are some that would like to see a whole lot more, but risk-weighted capital at the average of where we were, I don't think we're far away from what it would take to survive another 2008. The rule is too pro-cyclical, and there are ways of addressing that without being dramatically, kind of radical in your modifications. And one of the things that we have to be careful about on the leverage ratio that we haven't mentioned today is the GSEs are selling off a significant amount of that credit risk that is no longer being borne by the taxpayers, and that's going to increase over time. We could increase the detachment point. We could do a lot of things to protect the taxpayers a little more, but I don't think radical changes are needed. But I read into some remarks that we are going to see more dramatic, which could significantly affect pricing and so on.
Norbert, what do you think? I mean, what would you do if you were in those shoes?
Well, I mean, so we're just speculating.
Yeah.
I mean, but the thing is, they're not a bank, they're not an insurance company. They're a unique sort of entity that does one thing. So you could argue they're a monoline insurance company sort of thing. So you could base them off of a PMIERs, sort of system, which is kind of what that rule does. And the truth is, none of us really know what the right number should be. It's just like with banks, just like this is all arbitrary to some extent, and we're basing it on things that have happened in the past. And the problem with all of that system, that entire Basel system and all of that, is that it works great until it doesn't. Mm-hmm. You have enough capital until you don't. So I'm almost agnostic, and I almost don't even care anymore, because whatever it's going to be, and it's either going to be enough or it's not going to be enough.
Just one thing about reproposing and so on. I mean, one of the things that we asked for was more transparency, both with respect to data, but also with respect to the capital models that the GSEs and FHFA uses actually to estimate and put out that proposed rule. That's still quite a black box that we would all like to see more of as we comment on whatever the reproposed rule is, if it is reproposed. We want to see more.
It's striking to me how
transparency.
similar some of these conversations are to Dodd-Frank and thinking about the banks and unwinding and trying to get them back into solvency and stress testing and black box, like figuring out what those requirements are. It just reminds me very much about those conversations. GSE footprint, what is the right size? Dr. Calabria sort of talked a little bit around that and seems intent on moving them, shrinking their size, if I understand him correctly. Can you talk a little bit about how do you do that without it being disruptive? And is there a magical number, or are we talking about the same thing that we were just saying earlier? It's so hard to tell.
Yeah, I don't think there's a magical number. But obviously, if you're supposed to have these two things that are sort of pro-cyclical safety nets, they shouldn't be backing half the market. Mm-hmm. But to get from there to wherever optimal is, if optimal is not zero, I'm not really sure where that goes. My optimal is zero. If you look at the homeownership rate in the United States before we had the GSEs, it's almost exactly what it was right now. You can't possibly make an argument that they've actually increased homeownership in the United States. Mm-hmm. They've increased the hell out of debt. I don't know how that's a good thing necessarily, and it's mostly risky debt in the last 20 years. That's not a good thing. You can make an argument that they've made homes less affordable, especially at the low tier, entry-level home prices. None of that is good. So I would say my optimal is zero. I know that's not going to happen either, but.
I'm sorry, go
No,
ahead.
after you,
No,
please.
please.
I would simply add, to tie a couple of those threads together, one argument I've found really interesting this week is the idea that, to my mind, adding additional capital to the GSEs, which we all obviously welcome, does nothing to address the riskiness of the activities that the GSEs propose. It simply offsets that risk. The only way we can really truly get to the true risk that the GSEs present is to change the activities they perform to the degree possible without amending the charter. But what I find really fascinating is the idea that although some work has been done in pilot programs in the multifamily loan caps to reduce the scope of the GSE, so much more needs to be done. But what is interesting is that those bits left undone happen to be the parts of the GSE's business that make them the most money. And that being the case, any attempts to decrease the GSE's footprint will necessarily make them less attractive to investors.
And the other thing about that point is that if cash out refi or single-family investor loans are so overpriced relative to crisis risk in a severe, adverse severe scenario, why aren't other sources of capital making those loans and underpricing the GSEs because it is the source of substantial cross-subsidy that they use to really subsidize the rate for higher risk single-family borrowers. And so the liquidity question of if they were to simply lop off, not only does it reduce profitability, if they were to lop off cash out refi, second homes, investor loans, not only are they less profitable and so on, the question is, are there other sources to pick up that reduction in liquidity? And if there are, why are they not, when they're penalty pricing those loans now, why aren't those other sources picking off those loans?
Right. Let me ask you about affordable housing in QM, and then we can open it up to some questions here. But we mentioned it at the top of the conversation, but what role does affordable housing need to play in this conversation? And in terms of your views on the QM patch, it seemed clear that Dr. Calabria thinks no extension. It didn't even sound like there was any wiggle room past that. Is that the right fix? Is that the right approach? And what are your views on that across the board?
You first.
I mean, lack of consensus around the GSE's role in affordable housing sunk our legislative efforts in 2013, 2014. They continue to be of great concern to a lot of folks. And just let me mention the FHA issue for a moment. The Treasury and the HUD plans are very different. Treasury is all about really what the role of another set of entities should be, right? Fannie and Freddie. The HUD plan is a confessional, right? I mean, it says, and I give them credit, it says that FHA is just one hot mess. The cost of servicing a defaulted mortgage at FHA is 50 times the cost of servicing a performing loan in the GSEs. It's 17 times. They've got 40-year-old technology that they say that has actually experienced 104 outages of their single-family platform in 2018 alone. And at the same time, they want to increase capital. They want to risk-based price FHA, while the director thinks that moving some of this business will be good to FHA will be good when there's just no, A, there really is very little coordination, and B, FHA is not in the business prepared to take on the responsibilities of shifting the vast majority of affordable lending to the federal government FHA program, in my view.
No, I totally agree with Mike. They're not prepared to do that. I would, if we're talking optimal, again, I would like to see everything consolidated in one place. I'm not saying FHA is it, but if we're going to do affordable housing stuff, which, by the way, has not really made housing more affordable yet, but if we're going to do that, let's make it transparent and put it in one agency and do one thing, not all these different programs, and not, if there is some sort of help that we're going to decide to give as a nation to some people to get housing, why does it have to be financing? If as a financial planner in a previous life, I would never have told a client who had variable income or low income, hey, I've got a great idea. Take out a 30-year mortgage with nothing down. I mean, I could lose my license. I mean, that's insane. So we shouldn't be doing that. But that's what we're doing. So if that's the affordable housing plan, we should stop doing it. And if we're going to do something else, let's just make it transparent, make it a budget item, put it all up front.
Yeah. Tom, I know you have views on this.
I think all I would add would be that one of the many bitter truths in this area is that I certainly can't articulate a path forward for housing finance reform that doesn't make mortgages more expensive. And what's even worse is that unfortunately I don't see that as being necessarily a bad thing in terms of attempting to remove some of the risk from this market.
Yeah. So we'll see if we have any questions in the audience.
floor is open. Reminder to state your name, affiliation, and use a question mark.
Hi, it's Jeb Mason. Thought I'd just push on what Thomas said there at the conclusion. Just curious if you think that need be true if administratively the administration's successful in imposing the right capital rules as well as a periodic commitment fee to charge for both the explicit and implicit, perhaps, portion of the backing that the enterprises already enjoy. I mean, wouldn't that conceptually make it so that comprehensive housing finance reform legislation, at least using Corker-Warner as a proxy for what we might expect that to look like on a bipartisan basis, couldn't that actually succeed in lowering costs?
I would agree entirely. Ideally, that makes complete sense. Ideologically, it's sound. I would hope that we could get to that sort of position. I've seen nothing that suggests that the government is capable or willing to price risk appropriately.
Any other questions?
Okay. If there's no further questions, please join me in thanking this wonderful panel.
Thank you.